Welcome to the Mid-Year Outlook from Principal Wealth Partners. I'm Julina Ogilvie, Partner and Wealth Advisor, joined by our founder and CEO, Bob Paolucci. Bob, happy summer.
Hello, Julina. Good to see you.
It's good to be seen, and we are officially in the second half of the year. We talked a lot about what to expect in the first half of 2023, so we thought today we would quickly review that conversation and then spend some time going into the outlook for the second half, if that's fair.
Sounds fair to me.
Okay. I know you have a great visual to kick it off.
I do. So, you thinking about the first half of this year, we entered a bull market, something that we had mentioned would happen in January. And here's a great visual. It's the running of the bulls. In a cute way, we named the bulls Google, Amazon, Apple, Microsoft, and NVIDIA. And the people that are getting trampled over is the rest of the S&P 500. Really meaning, what has really moved is those handful of stocks, and the rest of the S&P 500 has sort of lagged behind, but ultimately the market has moved into bull market territory. It's something we'll talk about later on in this presentation.
Right.
A quick look back at our view of the first half from January. We talked about, the weak points that were in the news and in the financial media becoming strengthening points. So inflation, interest rates, a resilient consumer. We talked about at some point this year, we would see a bear market turn into a bull market. We had talked about valuations being so low that it supports a rally, corporate earnings being really in good shape. Relative to what the market was pricing in last year. So that had to lead to better things, and it did. We talked about being able to invest in and receive higher income from various investments. We talked about the strength of dividends and buybacks. Again, this is coming out of last year. This is something we talked about in January. Projecting forward would be very helpful to the capital markets, and it has proven to be the case. And our question mark was recession. It was too close to call, very hard to predict, and that is still the case. So we'll get into it a little bit. We'll talk about inflation. The reading on inflation for June just came out yesterday. Today is Thursday, July 13th. The reading for June came out yesterday, July 12th, and it showed a remarkable decline in inflation year over year. So yesterday, Julina, as we predicted, not going to be shy about this, we have a 2.97% inflation rate, to be exact. 1 year ago, we had a 9.1% inflation rate. So this is something we were very passionate about, saying that, look, inflation really just needs time to come down. And time has passed. Here we are a year later. Mission accomplished. We have inflation in the twos.
And really quickly, that purple that you just shared, that purple line, that summary at the bottom, if you can't see it, is 67% difference.
Yeah, that's greater than a 2/3 decline in inflation in 1 year. Has never happened before. We also hit the 12 consecutive months of declining inflation, which has never happened before in history.
Right.
So
amazing.
Yeah, I'm still shocked to hear members of the Fed and financial gurus act shocked at how much inflation has declined. And you're even hearing some data points. We're starting to see inflation decline.
Yeah.
What planet are they from? Inflation has been declining consecutively for 12 months. It has never happened before. A 70% decline over 12 months has never happened before. Inflation has come way down, and we believe it's likely going to stay there. Probably flatten out from here.
But Bob, some might argue that it doesn't feel like it, and so maybe that kind of leads into the second point.
Yeah, well, it depends on where you spend money, right? This is the national calculation, tabulating all items. If you're buying a car and looking to rent a house in Manhattan, and paying for tuition at an Ivy League school, then certainly you're experiencing a different rate of inflation than the national average. But the Fed doesn't care about your inflation; they care about national inflation.
Good point.
That is the metric that they go by. Here's a data point that shows really all the items, all the inflation items are declining pretty rapidly. Energy is not only has low inflation, there's deflation in energy. You see the negative 1.54% year over year. That's 4 consecutive months of deflation in energy, and many other things are probably going to follow suit. And again, this is just a quick recap. Interest rates, we think the next 100 points, 100 basis points, 1 full percentage point move will be lower. The Fed is flirting with doing another quarter point increase, which to us isn't that meaningful. If they do another quarter, it is simply because they want to be able to cut more in the future. That's the way I view it. So don't get too emotional about it. Don't worry so much about it. The consumer, why have we had this rally? Why haven't we had a recession? Again, these are recap slides here. We've had a resilient consumer. They are still saving money. They have excess cash. It's running low, but they still have excess cash. And consumer credit, so debt of the consumer relative to disposable income, is still very, very, very low. Mm-hmm. You may be fooled into believing that credit card usage and consumer debt is rising rapidly. It's not. You have to look at what it's relative to. Ultimately, if it's compared to disposable income, outstanding credit as a percentage of disposable income is still very low, lower than it was in 18 and 19. So the consumer is still in relatively good shape, and that's very important. The other part of the consumer is they're employed. Most of them are employed, right? So we have, for the most part, what I would call full employment. Unemployment levels that start with a 3, right now it's 3.6. That is full employment. Right. That is as much participation as you can really get. I think the next stop for unemployment is a rate that's higher. So I think we are going to have a little bit more unemployment, and that may lead to a scenario that gets us closer to a recession, but we'll get into that a little later. Mm-hmm. Here's a chart of the indices from their low in October. Let's call it the October 12th low. You see that the NASDAQ is up about 39% from October 12th of this past year. The S&P 500 is up over 20%, hence the bull market. You have the equal weight S&P 500 almost up 20%. I think it'll get there soon. That means you'll have a full participation of the market soon. And then you look at small companies up about 12.29%. That index should be in a bull market very soon as well. Valuations, the market is not really expensive. This is the current PE. Forward PEs are a little bit lower, but the market is not outrageously expensive at all. Looking at yields across the board, I'm going through this quickly because I'm going to get into our outlook for the second half in a minute or so. But when you look at interest rates, 3, 6 month, 1 year, 2 year, 3 year, 5 year, 10-year yields, they're still very attractive. We have short-term rates in the 5s, intermediate-term rates in the 4s, and very long-term rates in the 4s and 3s. It kind of is backwards. That's an inversion, but rates are significantly more attractive than they were a year ago. Mm-hmm. Here's a chart that shows a year ago, 1 month, 3 month, 6 month, we're in the 1s and 2s. 2 year, 3 year, 5 year, 10 year was also in the 2s, and long-term bonds were 3s. So you now have, for the most part, rates, at least on the short end of the curve, that have tripled. The medium part of the curve have doubled, and the long part of the curve have, increased by, 30, 40% or so. So rates are higher across the board. Corporate earnings, really the driver of the market over long periods of time. Earnings have hung in there. Last year, the market was down in anticipation of earnings in the future coming way down. Earnings have not come way down. Therefore, the market direction last year was wrong. So the market righted its direction so far this year, and it has come back up. Right. And it has come up because of earnings not falling as expected. Does that make sense, Julina?
Absolutely.
Yeah.
Yep.
And we think earnings will continue to hang in there. And our outlook for 2024 next year is that earnings will increase by quite a bit.
Yeah.
And it's not only us that are forecasting that, it's all of the other big Wall Street firms. So,
and as a reminder, that's the driver of future return.
that is the driver of the market over long periods of time. Yep. Yeah. Higher income. This is just a chart of the range of yields for various bond asset classes. The averages, the 10-year median, and the diamonds are where yields are. And you can see just about everything across the fixed income asset classes are near their highs over the past decade. So there is an abundance of yield out there for investors, of which we are certainly taking advantage of. And that makes us very excited. Dividends and buybacks. So, when you gauge the health of a company, right? Cutting back on dividend payments, suspending dividend payments, and reducing buybacks, that is a sign of poor health of a business. However, when you look at the market glued together, the S&P 500, you have dividend increases and increased buybacks. So I believe the underlying companies of the market are actually doing quite well, regardless of some of them giving slightly negative guidance. They're doing it at the same time that they're giving dividend increases and buying back more of their shares. You don't do that in an environment, in a bad environment. Does that make sense?
It does. And I love the correlation to the red line of the S&P, because it's showing the dividends and buybacks in the bars and how they're correlated to the return.
Absolutely.
Yeah.
Absolutely. A recession, again, too close to call. We'll get into this a little bit more, but these were some of the charts that we had talked about in January. These are the major data points that help the nominating committee that calls a recession a recession. You typically like to see a lot of alignment of red, which makes it easy to call a recession. And you look at the 2022, 2023 categories, you don't have alignment. You could argue that there's a rolling recession, parts of the economy that have done poorly and parts of the economy that are doing well. But right now you don't really have alignment. We may get it later this year. It's still too close to call. We may push out that risk into 2024, but if we end up with a recession, it will be a very brief, very, very, very soft recession, and then we'll move on.
Yeah. And I think to make it clear, we've been saying from the beginning of the year that the second half would look different from the first. Thank you for reviewing that. It's a great setup for the outlook.
And that leads into our outlook for the second half of the year. How about that? So we expect a deeper and broader market. So ultimately, the top 7 companies of the S&P 500 have driven most of the return of the S&P 500. Mm-hmm. 493 companies of the S&P 500 glued together have come up about 5%, let's call it. We think there will be more participation of the other part of the S&P, which is most of it, in the second half of this year. You keep in mind, Julina, someone has to lead. And I think it is normal for your leaders, the names to start leading, and then for everyone else to follow. So it is not that unique of a situation to have a handful of names start moving ahead of the remaining components of the index.
Right.
It just so happens that they are the largest pieces of the index that have moved together up at the same time and left everyone behind.
And this should be good news for investors.
Absolutely. Yep. Absolutely. We think inflation goes sideways for the rest of the year. The easy declines of inflation are behind us now. And now it'll be sort of a sideways, choppy path, which will end up resulting in lower inflation, but we're not going to have a 70% decline in inflation over the next year or a couple of quarters. It will be baby stepping slightly down, slightly up, slightly down, slightly up. It'll probably be a net sideways move for the next 6 months, and more declines coming in 2024. Keep in mind, we're at 2.97% inflation, and the Fed's target is 2%. So we're not far away at all.
Exactly.
Small cap stocks, we think, will join the party. Small companies are much more sensitive to a slowing economy, much more sensitive to higher interest rates. We think we'll either avoid a recession, or if we have one, it'll be a very soft, very quick recession, and then onward from there. So a great time to invest in small cap companies. Again, our next data point, we think we avoid a recession in 2023. 2024 is in play. That's like kicking the can down the road, kicking the problem down the road. Keep in mind, Julina, next year is an election year, and all politicians really want to avoid making hard decisions. They want to make promises, most of which will not be kept, and they don't want to make any difficult calls. They don't want to have bad news. So if we end up talking about recessionary stuff in the first quarter of next year, look for the current administration to put a ton of pressure on the Fed to end any fears of a recession. I'll leave it at that. Also, the Fed doesn't want to have much influence on politics. So more to come on that. There is something we should talk about, though. The student loan payment moratorium is over. So payments restart in October, and it's quite a bit of money that has to be repaid. The monthly minimum payments are pretty significant throughout the country. When you look at the amount of outstanding student loan debt, there's a little over $1 trillion of student loan debt, and the minimum payment on that is pretty significant. That has to come from somewhere. That will come out of the discretionary pocket of consumers, which means they won't be spending as much money on some other discretionary items. So that could slow the economy a little bit. And the Federal Reserve is either done with their interest rate hikes or soon to be done, and they are going to start using good old-fashioned BS, their words, to help frame the narrative. More to come on that. We will show you some slides. So here we go. The real bull market is in Amazon, Apple, Microsoft, Google, and NVIDIA. So when you minus them out of the S&P, just for fun, the remaining 495 companies, let's call it, are up 5%. Those companies are up 47. The other companies are up 5. So the S&P together is up about 13. Again, a very narrow bull market, very thin bull market, very concentrated, we think will broaden out second half of this year. So I think this visual is very helpful for investors to say, wow, it's really those 5 companies that have moved, and the rest really haven't. And that's true. More participation to come second half of the year. Inflation going sideways. So we've shown this chart before. We're showing the monthly numbers of inflation that are going to roll off as the new numbers roll on. So the July inflation number that comes out in August, last year's inflation number that rolled on was a 0. So, so a 0.1 reported next month, in essence, will move inflation from 2.97 to 3.07. So that's a tiny increase, but it's very hard to beat a 0. You can certainly have negative numbers, but we think we'll just have very low, close to 0 numbers roll on. But what's rolling off is going to be the same close to 0, slightly above 0 number. So hence, this is the backing for our prediction of sideways choppy inflation for the next at least 6 months.
And I think, as a reminder, we showed in the webinar last month, the June number for last year that just rolled off, that has now gone off this page, was 1.2.
That's right. 1.2 rolled off and 0.2 rolled on. So 1 full percentage point of inflation just evaporated.
Exactly.
with this most recent report. So, however, Julina, if we measure inflation real time, we had mentioned in the past, housing is probably the most delayed indicator in the inflation data.
Yes.
And the government's inflation measurement is incredibly stale. If you replace it with the live measurement of housing, you have inflation data that looks even lower. So if you measure live, inflation is really less than 2.5%. So the fast forwarding the lag effects, in essence, showing of housing, you have an inflation rate that is right in line with where it should be, which is why we keep arguing against further rate hikes. We understand the Fed wants to have ammo to fight a slowing economy, and the ammo will be more to cut. So therefore you have to increase a little bit more so you can cut a little bit more.
Exactly.
But we see value in just pausing and giving it time. But the rationale is inflation is where you need it to be. But who are we? The Fed is going to do what the Fed is going to do. Backing up our small cap opportunity idea is, when you look at the valuations of small caps versus large caps, you have a historical spread, something we haven't seen ever in history.
Amazing.
Small caps are very cheap relative to large caps. And for our clients, if you're listening, we started baby stepping our way into small cap investments over the past quarter. We plan to do that slowly and in small doses over the next couple of quarters, because there's an enormous opportunity. There's a chart that certainly proves it out again. When rolling returns, 5-year annualized returns for small caps are less than 5%, which they have been for the past 5 years, the subsequent 5-year returns are astonishingly good. So almost 15% for the following 5 years.
Right.
And this data goes back to the 80s. So it is very consistent. So I'll leave it at that.
It's better than any rolling 5-year period of small caps in general, which is the 10.4. So that's quite a difference and quite an opportunity.
Absolutely. So this next chart is interesting. This is the tale of two economies. The two economies that actually exist in our economy, Julina, are manufacturing and services, right? They're both measured separately, reported separately. And what you have here is the black line is at the number 50, right? The manufacturing index has a current level of, let's call it 46, and services have a current measurement of 54. So it has been the rule that these data points, when they report numbers under 50, there's a good chance you're either in a recession or you're about to have one.
Correct.
Manufacturing has been below 50, flashing a recessionary signal since October of last year, and it has only gotten worse, not better. However, services, the slightly bigger part of the economy, is holding the total economy together.
Offsetting it, yeah.
Yeah. And think of services as travel and entertainment, restaurants, going out to eat, all that fun stuff. Obviously, it is still rebounding from the pandemic, and manufacturing is declining from a level that was very hot 2 years ago. So it does make sense. But you really do have a tale of two economies. One part, manufacturing, is actually in a recession. The other part of our economy is in an expansion. And the net result of that is still some positive economic growth. I do want to point this out because it's very important to understand this. The student loan moratorium, no more, just showing you the share of student loan debt by age. The bulk of it is held between 18-year-olds and 49-year-olds. And when you look at the amount of money that needs to be used to maintain the cumulative minimum monthly expense it's pretty significant. It's billions of dollars that we're talking about
Right.
monthly.
Yeah.
So we are talking about $8 billion a month in minimum student loan payments that haven't been made in a few
In a
years.
few years. Yeah.
And when you're not making a payment for a few years, you forget you have the expense. So, I would expect where the 18 to 40 year olds are spending money, if it's buying high-end Lululemon attire, or Chipotle, so on and so forth. I think something has to be reduced to account for this new minimum monthly expense. So just be on the lookout for that. We're certainly taking a close look at
You
it.
have to change your habits again, which is not
Yeah, I
easy
mean,
for
you have
everyone.
to. You have to. Yeah. And our final slide here is the Fed's new message. And this is cute. It's professional BS. And what we refer to BS is what you're thinking of when we say BS. This chart looks so innocent,
Thanks
but
for clarifying that.
what you really have here, Julina, is this is put out by the Fed, mind you. This is their chart.
Exactly.
What they are saying is they expect inflation to continue to moderate, to get closer to 2% over the next year, 2 and 3. They also expect to have to cut rates over the next year, 2, 3, and 4. Cutting rates down from a little over 5% down to 2.5%, which is their long-term target. But there is some BS in this. They are saying that unemployment, they think by the end of the year, the rate will go from 3.6 to 4.1. And then next year it will be 4.5. And then in 2025, it will be 4.5. Well, I could tell you, if that's what happens, you will not have economic growth. You will have a recession.
Yeah.
You will have a recession. And the top category, the change in real GDP, they are still forecasting positive economic growth. You're not going to have it if unemployment goes from 3.6 to 4.1 to 4.5 and stays there. So this is absolute BS. You might as well put a unicorn up on this chart. It's not going to happen that way. So again, more to come monthly from us on that. We do think the second half of this year will continue to bear fruit. There will be more participation from those companies in the market that haven't participated. We think small caps will be a great opportunity the second half of this year. We think the Fed is either done or will be done with potentially one more rate increase. And then we'll get into 2024, which we expect to be a very, very good year. So more to come on that.
Fantastic. And I appreciate the fact that you even gave the conclusion for me. So this is an easy day for me.
Yeah. And, I feel for the listeners. We do go through a lot of information. There are a lot of slides. We do that really just to keep you informed. I see no value in giving you a 30-second view of the world. You can get that by listening to everyone that comes on to the financial media nowadays. I think giving you a granular view is more helpful. It's the stuff that we use to make decisions. And I think sharing that with you, the listener, our clients, is very important.
Yeah, and I think it's also a great indication that there are so many moving parts to the economy and the markets. And so just giving our clients and whoever's listening an idea of the way we think about it. And I think that the one clear thing that we're getting out of right now is that when it looks from an economic perspective, it looks very muddy, and hopefully you can get an idea of why that's the case. And so, but regardless, we're still optimistic the second half of this year. So thank you for going through those points. And as always, we're around and available for anyone that has any questions or concerns. So Thank you,
Absolutely.
Bob, for your update again.
Yeah. Thank you, Julina.